Welcome back to Talks with Dr. Gupta and friends. If you are allocating capital for the next decade, you are navigating the single largest structural shift in economic history, the transition from human labor-driven growth to autonomous compute-driven output. To position a portfolio for long-term compounding, we must cut through the hype and separate digital software velocity from physical manufacturing reality. Techno-optimists like Elon Musk predict that digital AI will surpass human intelligence within 3 to 5 years, driving full robotic superabundance within a decade. Macro investors like Ray Dalio remind us that technological expansion always hits physical, financial, and geopolitical walls. As equity investors, here is the empirical framework you need to price into your models. Cognitive labor automation is an immediate, high-conviction reality. Within 3 to 5 years, screen-based tasks, routine software development, legal document review, financial analysis, and customer operations will achieve what computer scientists call stockfish-level dominance. Platforms built by Anthropic, OpenAI, Microsoft, and Alphabet will render legacy white-collar labor non-competitive on cost, speed, and accuracy. However, physical labor automation through humanoid robotics faces a much longer timeline, realistically 10 to 15 years. Shaping atoms requires physical supply chains. It demands rare earth elements, advanced actuators, high-density batteries, and massive baseload electricity. The bottleneck to full automation is not machine intelligence. The bottleneck is the physical grid, ASML lithography machines, TSMC chip fabrication capacity, and the speed at which we can build energy infrastructure. For investors, the immediate play is not betting on generic software apps. It is owning the physical choke points of global compute. When this automation wave peaks, global capital flows will re-rate every sovereign economy. The clear winners will be compute and energy superpowers. The United States and China currently control the vast majority of foundation models, semiconductor IP, and energy investment. Meanwhile, heavily indebted nations with stagnant productivity like the United Kingdom face fiscal margin compression as white-collar tax bases shrink. However, the most critical case study for global allocators is India. India is home to 1.5 billion people, a massive demographic dividend, and a tech services sector led by giants like TCS, Infosys, and Wipro. That sector exports over $200 billion in IT and business process outsourcing annually. As global enterprises replace third-party human labor with autonomous software agents, India faces the imminent risk of premature deservicization. Compounding this exposure are domestic structural hurdles like severe wealth gaps, fragmented regional politics, fragile physical infrastructure, and administrative friction. If millions of entry-level engineering graduates find their corporate pathways disrupted simultaneously, traditional GDP growth models will fail. For equity investors in emerging markets, this requires a fundamental portfolio pivot. Legacy IT service export multiples will compress as value moves away from labor arbitrage toward domestic infrastructure, power generation, and sovereign digital networks. This reallocation will favor conglomerates like Reliance Industries and Tata Group that own domestic infrastructure and sovereign digital networks. India and other emerging markets must turn disruption into a compounding engine by executing 5 concrete strategies. Action Plan 1. Build sovereign compute and energy infrastructure through public-private partnerships. India needs domestic data centers and fast tracking of small modular nuclear reactors. Scale chip packaging and semiconductor ventures like Tata Electronics to reduce import dependence. You cannot run an AI-driven economy on imported cloud infrastructure and an unstable power grid. Action Plan 2. Upgrade digital architecture like Aadhaar and UPI to manage structural labor shifts. Capture a share of automated productivity, and distribute direct corruption-proof digital AI dividends to sustain consumer spending. Action Plan 3. Overhaul university curricula away from 4-year legacy coding degrees. Institutions like the IITs and IISc must pivot to mechatronics, power engineering, robotics, and complex system synthesis. Education must become a lifelong reskilling platform rather than a static early life credential. Action Plan 4. Founders must focus on deep tech solving physical world problems rather than thin software wrappers. Venture capital should fund AI optimized agriculture, smart logistics, localized healthcare diagnostics, and industrial automation for emerging market costs. Action Plan 5. Young professionals must move away from middle management ladders toward micro-entrepreneurship and physical trade mastery. The future will favor micro-entrepreneurs who leverage AI tools, master energy and hardware assets, and deliver high-touch human services. As investors look to compound wealth across this cycle, we must address the ultimate macro destination: money, purpose, and portfolio positioning. Elon Musk suggests that basic safety nets will evolve into universal high income. If AI and robotics drive the marginal cost of producing goods, energy, and healthcare down towards zero, we will see structural economic deflation. In a world of extreme abundance, printing digital currency to support baseline living standards does not trigger classic hyperinflation because output scales faster than money creation. In this landscape, traditional work becomes optional, resembling a personal vegetable garden. You do not tend a garden because you need the calories. You tend it because you value the craft and human connection. However, the greatest societal risk is not material scarcity. It is a crisis of human purpose and political stability. To prevent social friction, sovereign wealth funds, modeled after Norway's pension fund Global or the UAE's Mubadala, must acquire equity stakes in hyper-monopolized AI platforms. This allows nation-states to fund public infrastructure from capital returns rather than enacting growth-destroying wealth taxes. For wealth managers and equity investors, your actionable game plan for long-term compounding boils down to 4 portfolio pillars. Own the compute choke points. Maintain core long positions in irreplaceable hardware monopolies like ASML, TSMC, and NVIDIA. Bet on energy infrastructure. Allocate heavily to base load power providers, nuclear technology, electrical grid modernization, and critical commodities like copper. Hedge with hard assets. Maintain allocations in physical real estate, sovereign gold, and hard reserves to protect against fiat currency recalibrations during debt restructurings. Avoid labor-heavy intermediaries. Underweight legacy, IT service providers, traditional back-office outsourcers, and low-mode software application layers vulnerable to agentic disruption. By aligning your capital with compute sovereignty, energy dominance, and hard physical assets today, you position your portfolio to compound through the greatest economic transformation of our generation. Thank you for watching Talks with Dr. Gupta and friends. Stay sharp, stay informed, and let's keep analyzing the forces shaping our world.